Why are stocks down today? And what should you be doing now? And what happens next? Let's look at some data and let's put it into perspective. This is the NASDAQ 100, the QQQ. Over the past 5 years, it's up about 105%. You can see it got up here to $403.99, November 19th, 2021. Fell off a cliff in 2022, and it's trying to rebound here in 2023. Even after today's sell-off, the QQQ is still up about 40% year to date. It topped out around July 18th at $385.74. So if you go from peak to where we're at now, it's not quite 5% off that top. Now the S&P 500, this is the Vanguard 500, the VU, it's up about 57.5% over the past 5 years. Same kind of deal, topped out here around $435 or so end of 2021. Fell off a cliff all the way down to $333 October 7th and back over $409 a share. Year to date, still up 17%. Now, of course, on the average year with dividends reinvested, you're getting around 10% on the S&P 500. And that's not going to be consistent every year. There's going to be peaks and troughs. There's going to be ups and downs. Now, this chart is looking at the S&P 500. This is the PE ratio forward estimate. And you can see it's come way off the lows here between Q1 and Q3 of 2022. And we're sitting at about 25.29 right now. Now, this is a 90-year historical PE chart. You can see way back here in 1950, 5.9. May of 2009, it was 122.39 according to macro trends. In 2021, we were hovering around 29. And this came closer to 20 in 2022, and now it's sitting up here July of 2023 about a 26. So back in September 11th, after the Great Recession, we were sitting around 13. You can see it climbed up. October 2012, 16. June of 2014, you had a 19. It kind of slowly grinded up here, topped out around 24. And so the market is not the most expensive it's ever been, but it's not cheap either. Now I'm going to show you some slides here in a couple minutes, and it's going to show you some positives and some negatives about the macro. And one of the positives is actually that earnings have been beating. Over 80%, I believe, of earnings that have been reported have actually beat estimates. Now those estimates, the bar has been set pretty low. Expectations have been low. And someone made a comment this morning about how you look at quarterly year-over-year growth and it's actually declined on a specific stock. And I made the point that it's not just one stock. If you look at some of your favorite stocks here, I've got Palantir, Alphabet, NVIDIA, you can see the list, Snowflake. And you can see by looking at this chart, you go back to 2020 and you've seen some of those kind of pop up and then kind of decline down. And this is really across the board. This is a wide mix of growth stocks here, from semiconductors, you've got mega cap tech, you got some of the cloud names in here. You've seen a deceleration from those peaks and expectations have been low. So we're beating earnings, but on low expectations, and growth is still decelerating. So let's look at the macro, some positives. So far we've had about 86% of the S&P 500 report earnings, and nearly 80% of them have beaten Wall Street expectations according to FactSet. Again, expectations are low. Also this morning we had a news headline, Philadelphia Fed president suggests interest rate hikes are at an end. Now, of course, this has been the push-pull dynamic that we've seen with the market and why the market's been so volatile over the last 18 months or so. The Fed came out at the end of 2021 and said that inflation was transitory. And I think most of the market believed that. Of course, we know now that inflation wasn't transitory, and it spiked all the way up to 9% in the summer of 2022, and that's come down to around 3%. It comes down to economics, supply and demand. So they're raising interest rates to essentially try to lower that inflation, and that's going to do that by lowering demand. It's going to have impact on jobs and so on. So you have a lot of push-pull dynamics of these macroeconomics. So some negatives. We had a VIX spike today. And of course, the VIX measures volatility. Today, it's up 12.43%. It was actually higher than that this morning. I think I saw it closer to 17%. Right now, the VIX is sitting at 17.72. So it's still under 20, but a significant spike. Bond yields are still over 4%. And of course, you probably know bond yields are going to have a dramatic effect when you think of growth stocks, risk assets, risk on, risk off. So those hyper growth names, those high valuation stocks, those cloud SaaS type names, they get hit harder when bond yields start to creep higher. Payrolls are also starting to show weakness. Last Friday, we saw some weakness in payrolls. And this is where we say we're going to have a hard landing. We can have a soft landing. If the job market's strong, interest rates, we can kind of survive through this. Well, now we're starting to see some deterioration in payrolls, and that's something to definitely keep in mind. Now, unemployment's still historically low, but we are showing some weakness. And of course, we have high interest rates, and high interest rates are going to create lower disposable income. 68% of our gross domestic product is basically people spending money, buying stuff, consumers. Now, if you look at the average consumer, they're going to spend a lot of money on their mortgage or their rent. As those rates go higher, it's going to make mortgages and rents higher. It's going to have effect on that because there's less disposable income. You also have things like student loans that are going to be coming back into play. So people are going to have less money to spend, and that's why there are concerns about a potential recession. Now, just this morning, we also got some news on credit card balances jumped in the second quarter and are above $1 trillion for the first time. So what is this telling us? So what it's telling us essentially is that people don't have as much money, but they're still spending, which is keeping that economy afloat, but they're going in debt in the process. And that's the thing with Americans, is that a lot of Americans, we're going to spend whether we have the money or not. And that's not necessarily right, but that's just fact. And so if people don't have the cash, they're going to put it on a card. What are the ramifications of that longer term? And really, what's next? I'm going to cover what's next here. I'm going to give you some final commentary, some real talk about what's going on with the market, what I'm doing right now, and what you should expect next. So on the economic data front, this is huge. We're looking at July's consumer price index that comes out this Thursday, just in a couple of days here. The inflation metric could put Wall Street's belief in a soft landing to the test. This could make the market sell off more, or if that CPI, that inflation number, if it comes in light, you could have a rally off of that news. So the market's selling off today for a few different reasons. We had some stocks like, for example, Datadog reported earnings, beat on the top and bottom lines, a little bit light on the guidance. And you kind of have, all the different names in cloud SaaS selling off in that news. But really the market just wanted an excuse to sell because a lot of these stocks have absolutely ripped in 2023. And people are taking profits because they might be concerned that this data might come in worse than expected and the market could sell off further. You had Dan Niles come on CNBC just a couple days ago and said the S&P 500 could have a 10% correction. Anytime you have 10% or more, it's a correction. Once you get to 20%, it's a bear market. Anything under 10%, you might get a 3 to 5% garden variety. Now, earlier I showed you the NASDAQ and I said we're down about 5% on the QQQ, the NASDAQ 100. And I told the gang in Discord that, you should expect something around a 5% pullback. And I was saying this a couple weeks ago that it's coming at some point. The market can't just keep going higher and higher every single day. So some selling off is certainly healthy, but it can also lead to a snowball effect because more people sell. You go from bullish sentiment to bearish sentiment, more people sell. There's still a lot of profits that can be taken in 2023, especially if you're investing in growth. Even if, like Datadog, for example, it's selling at $85 right now a share. If you bought that in the 60s, you're still up 30% and you're beating the S&P 500, by double. So CPI calling for a monthly increase of 0.2% in July and a year-over-year rise of 3.3%. So this is on everybody's agenda right now, and you have to be watching out for CPI on Thursday. So what comes next? And what am I doing right now? And what should you be doing right now? Well, I don't have a crystal ball. Of course, CPI is going to matter. We still have some important earnings for some big names. You got like Snowflake and a lot of these hyper growth stocks that still need to report. But I will tell you that I'm buying today, not only in the community portfolio, I'm also buying in my primary taxable brokerage, my $1.5 million brokerage. And then members from Elite in Discord, they share their buys and sells in real time in the investing trade floor. There's been a ton of buys today. And it doesn't mean that we don't think the market can't go lower. We're just buying specific stocks at specific prices using DCA, dollar cost average. If it goes lower, we buy a little bit more. And that's what we did in the community all through 2022. And it's paid off handsomely in 2023. So nobody in our private community is upset about the sell-off. In fact, a lot of us have been stacking cash and hoping for something like this to happen. Because a lot of us, including myself, I haven't really bought heavily since early in 2023. I pretty much went all in at 2022 towards the end of the year. The rest of the cash I had, I put to work really early 2023 and mostly in January. And I've nibbled a few things here and there, but I've been trying to stack up some cash, waiting for some opportunities. Now, I definitely think that more opportunities will arise, especially with individual stocks when they miss earnings. And that's where you can really get some opportunities as a long-term investor. But if you're buying growth stocks right now, especially if they've ripped hard, just understand there's still downside potential. And not just for growth stocks, really for the entire market. If that S&P 500 does sell off 10%, well, you're going to have some major sell-offs in some of those hyper growth names. So a stock like Snowflake that's hovering at 156, you could see that go to $110 to $125, and it shouldn't surprise you whatsoever. And this is why I always say you have to be careful when you're buying these speculative type names. And if you are, you really have to have a 5-year time horizon, and you really have to build a portfolio that meets your needs, your suitability, risk tolerance, and really hedges itself against these downturns. And that's why I teach having ETFs, dividend stocks, not just all hyper growth. You got some mature growth, you've got some hyper growth, you got some spec, but your spec is managed at say 10% of your portfolio. Days like today are buying opportunities. I've been doing this for 25 years. And of course, you're going to have red days, and it could be even more red on Thursday and Friday. We could have a major sell-off, and you want to have some cash available in case that happens. But when the market's down and some of your favorite names are back in buy ranges, I'm nibbling some shares. Now, generally in this type of environment, I'm buying, 10, 15, 20 lots. I'm not going all in. I'm just nibbling a little bit here. If it goes lower, nibble a little bit more. I shared with the gang this morning, there's a stock I'm buying. I want 2% of my portfolio. So let's just say it's $30,000. I'm buying, 5 shares at a time, $1,500 at a time, and I might buy 20 different lots. And what might happen is I could buy 10 lots and it might not go any lower and it could go the other direction. I'm okay with a 1 to 2% position in the portfolio. And that's really a strategy that those tactics work very well because it gives you room on the downside if it goes lower. And if it does turn around and go up, well, that's a high quality problem to have. All right, so hopefully you watched this video because you wanted to learn something, but I know some of you are just here for the best stocks to buy. So I'm gonna provide 5 stocks that I'd be buying right now if I didn't already own these shares at lower prices. These are areas where I would accumulate dollar cost average. Before I share those 5 stocks, if you're new here, subscribe to the channel, click that bell for notifications. I'm trying to get this channel to over 50,000 subscribers in 2023, and you can help me out by subscribing today. I appreciate it. Also, if this video is helpful, drop me a like and drop me a comment. And I do need to announce that this video is sponsored by the Motley Fool. If you'd like to see the 10 best stocks to buy now, visit fool.com/firedupwealth. A reminder, I'm independent. Fool doesn't tell me what to tell you guys, what to make, what to create, what to say. They're a great partner. Check those guys out. You can also join our private community, Patreon Discord, where you can see my buys in real time in both my portfolios, as well as all the buys and sells of our elite community members in real time in the investing trading floor. To join us, go to patreon.com/firedupwealth and join elite or higher. So 5 stocks that I'd be accumulating if I didn't own these already. I've been telling you for a while, CrowdStrike under $150 dollar cost average. Now we have to see earnings, and the stock certainly could go lower, and the stock has ripped from its lows. So there's certainly some risk there. But when I look at cloud SaaS names and I look at the metrics, the growth, the valuation, it's one of the most attractive names in that bucket, in that cloud SaaS arena. So all those names are expensive. They do have recurring revenue. They're long-term investments, 5-year holdings, and CrowdStrike certainly can go lower, but I like this stock $150 or less DCA. Now, Amazon already reported earnings, and I thought the earnings were pretty solid. That's a stock, if I didn't own it already, I'd be accumulating shares on weakness. Another stock that I think is a buy is Tesla. I would prefer it $200 or less, but honestly, $250 or less, I still think it's an opportunity if you're holding this stock for 5 or more years. Another stock to accumulate is Google. Now, I've owned this stock since $49 and I'm not buying it, but if I didn't own already, I think this is a quality company. It's not crazy expensive. I'd be buying Google, Google, Alphabet on weakness. And the 5th stock that also reported earnings that I thought had a decent earnings report, it's not cheap, it's expensive, but if I'm looking 5 years out and I'm looking at the runway for growth for this company, Shopify is another name that if I didn't own already, I'd be accumulating shares on weakness. So stay frosty. If you have a long-term horizon, you should be buying individual stocks that you've done your homework on, that you have conviction on, and nibbling certain stocks at certain prices. We use technical analysis every single Wednesday. We do chart day. We're going to be doing one in the morning. We go through 20 stocks and we try to identify the levels that might be buying opportunities. And there's no guarantee with technical analysis that I can't go lower, can't go higher, whatever, but it's giving you possibilities and it does work. It gives you an idea of where you should be adding as a stock is going lower when you're dollar cost averaging. So if you're interested in something like that, definitely join our private community, patreon.com/firedupwealth. Now, I just released a best 7 stocks to buy for the month of August. If you haven't checked it out, go watch that video. It's going to give you an idea of what some of the stocks are that we're buying. And if you want to see what we're buying in real time, not just me, but also the community members, visit patreon.com/firedupwealth, join elite or higher. Appreciate your time and attention. Have a great rest of your day. Take care.